Good day, Mr. Versosa.
Good day, Archdiocese of Zamboanga.
We are Group 3.
And we are here to present
Our second quarter task on FABM entitled Aspiring Entrepreneur Ivana Halave Case Study. But before anything else, let's discuss our prior objectives for today's presentation.
Our main objective for today is to briefly answer the following questions that are assigned to be discussed.
without further ado, let's begin discussing our group answers to the given questions to be presented. Number 1. Suppose that Halave used her own maintenance crew to build an additional wing on her existing facility. What would be the proper accounting treatment of the following items? Letter A. Architect's fee. Halave wants to create another route to her existing facility with the support of her maintenance crew, which implies that they will construct a valuable asset that will be part of the company's economic resources. As you all know, an architect's duty is to plan, create, and implement building designs, which is a significant aspect of a business. They are a component in the process of creating a place where you might want to launch a business. To explain from the point of view of the three accounting elements, assets, liabilities, and owner's equity, the construction of the new way to enable this facility will become an asset. As they will rendering a business, architects may have a service revenue or professional fees, or they may have a wage expense for their services given to enable this company. Letter B. Cash discounts earned from prompt payment on materials purchased for construction. Cash discounts earned from the prompt payment on the materials purchased for construction. It is to record the payment from the buyer to the seller that involves a cash discount. Now let me elaborate it further. Simply debit the cash account for the amount paid at debit, a sales discount expense for the amount of the discount, and credit the account. Receivable account for full amount of the invoice being paid.
Let's proceed to letter C. Interest on money borrowed to finance the construction. Halave's company borrowed money to fund the construction. And of course, whenever when whenever we borrow money on account, interest is expected from our transaction. Just like in Halave's case, the company borrowed money from lenders, which is responsible for charging them interest. So, when the due date comes, Halave's company needs to pay the interest expense and the loan payable that happens in the account. Consequently, they will surely lose cash in that transaction. Letter D. The cost of mistakes made during construction. This may happen in the course of time in letter D. In this situation, we are aware that Halave is conducting construction for his company that involves manpower of physical activity. Mistakes and accidents will be inevitable in the process, like injuries, equipment malfunction, or even natural disasters that of course Halave does not have control over. Still, Halave needs to prepare and take action before and after the inevitable mistakes. He needs to prepare for the liabilities if possible, run out of capital, medical fees, insurance expense of the workers, utility and maintenance expense in repairing equipment, vital, vital for the construction, and other incurred expenses.
Next, letter E. The overhead costs of the maintenance department that include supervision, depreciation on buildings, and equipment of maintenance department shops, heat, light, and power for these shops, and all allocation of cost for such items as the cafeteria, medical office, and personnel department. The business is in the position of paying some expenses incurred within the operation. And of course, if the business will be paying their expenses, such as the salary, operating, and utility expenses, we will lose cash in return. But it is also stated here that we allocated the cost of the cafeteria, medical office, and department store equipment, which means that we also gain different work equipments because we invested some of our capital or cash on hand. And for the last letter, for number 1, letter F, the cost of insurance during construction and the cost of damages or losses on any injuries or losses not covered by insurance. In this question, we will analyze the business did only 2 transactions, which are paying the insurance expense of the construction and medical fees for the uncovered payment of the injuries or losses not covered by insurance. With this event, as per the golden rule of accounting, once something is gained, there will be always a loss, which is the cash that is used for the payment of 2 expenses. And that will be all for the accounting treatment and question number 1. Let us now proceed to our question number 2.
Number 2. Suppose Halabe purchased a new machine. It is clear that the invoice price of the new machine should be capitalized, and it also seems reasonable to capitalize the transportation cost to bring the machine to the facility. Letter A. The new machine is heavier than the old machine is replaced. Consequently, the foundation under the machine has had to be strengthened by the installation of additional steel beams. Should this cost be charged to the building, added to the cost of the machine, or expense, and why? We think that the installation of additional steel beams should be considered as installation expenses. The new machine itself does not come in package with the steel beams, so it means that they are 2 different expenses. First is the replacement of the old machine, and second is the installation expense of the steel beams, which is why it can be considered as added cost of the machine, because the price of the machine is separate from the cost of strengthening the foundation under the machine, and they should not be paid as one expense. They can also charge their building because they are not the one who provided and manufactured the machine. Letter B. The installation of the machine took longer and was more costly than anticipated. In addition to time spent by the regular maintenance crew on installation, it became necessary to hire an outside engineer to assist in the installation and in working out the bugs to get the machine running properly. His costs included not only his fee, but also his transportation, hotel expense, and meals. Moreover, the foreman of the department and the plant superintendent both spent a considerable amount of time assisting in the installation work. Before the new machine was working properly, a large amount of material had been spoiled during trial run. How should all of these costs be treated and why? The time spent by the crew and the outside engineer can be treated as maintenance expenses since they are both working on the machine to work properly. The engineer's transportation, hotel expense, and meals is counted as accommodations and lodging, which is considered as travel expenses of the engineer. Since the foreman of the department and plant superintendent assisted the installation, it can fall under service expenses because they spend a considerable amount of time in helping the installation. And lastly, the spoiled materials during the trial runs are considered as spoilage expenses because the materials have gone to waste.
Letter C. In addition to the invoice price and transportation, it was necessary to pay a state sales tax on purchasing the machine. Is this part of the machine's cost and why? As we all know, machines are tangible products that are convenient in handling store equipment. Paying the machine is also paying the state sales tax because the cost of equipment is made up of the taxes that the business paid, transportation fees, historical cost, and other expenses that the business made in the creation of machines. That's why state sales tax is part not only in the machine's cost, but also in every other piece of equipment. Letter D. In connection with payment for the new machine, the machine manufacturer was willing to accept Halabe's old machine as partial payment. The amount allowed as a trade-in was larger than the depreciated value at which the old machine was being carried in the bookstores of the Halabe's company. Should the difference have been treated as a reduction in the cost of the new machine or a gain on disposal of the old one, and why? It should be treated as a reduction in disposal because of two following reasons. First, the machine is fully depreciated, and second, the machine manufacturer allows Halabe to make the old machine as a partial trade. This means that instead of additional payment for the new machines bought, we got a partial discount and trade.
And that is for the summary of our presentation for questions number 1 and 2.
We hope that we satisfied all of your inquiries about the Halave case study.
And we also hope that everyone has now deepened their understanding of Halabe's business.
And with this, we will end our presentation. Once again, we are Group 3, your inspiring or aspiring entrepreneurs. Bye!